Hi, greetings. Welcome back to the continuing lecture in Principles of Finance. This is Dr. Jeff Hong, and since our last class, we just started on in the last class on the new topic called risk and return. Actually, we wrapped up everything about the bond in the last class, and towards the tail end of the last class, we started on we downloaded Apple's price data for the last monthly price for the last 5 years, and then we have the file that we downloaded, right? I told you to save that file, and I have I did some, housekeeping with the file, with the data, because this is the original data that was downloaded. But when we downloaded it originally, it didn't look like this because it was in a default font. And I usually, when you download the data, it's in like a font face called Calibri, and the font size would be 0.11. But I told you the importance of cleaning up the data. Also, while you're cleaning up the data, you would, if possible, change the font, because the default font is not very vision friendly, and you can easily get tired if you're dealing with numerical data, and if it is not in vision friendly font, you get easily you lose interest quickly, and you get tired easily. So what I did was I highlighted the entire spreadsheet and changed the font to something I prefer. And the font size, I prefer always, point 14. Size 14 is, it looks like this, it looks decent, decent sized. And then, although Times New Roman is preferred, but to go down to Times New Roman, you got to scroll down a long list. So instead of going down all the way, somewhere slightly below there is a font family called Bakersville, which looks pretty much like Times New Roman. So I just, to save the trouble of scrolling down the long list, I simply picked that. That's fine. I mean, that's not. But anyway, I'm just talking about the importance of cleaning the data. And then I sorted, right? I sorted the data in descending order. Originally, it was in ascending order, right? Starting from 2015, right? But just select one cell, and by clicking on this, right, sort. But that's descending order, right? From Z to A, right? So click on it, and it sorts in descending order, right? So you have the most recent data on top, right? Now, then I told you to I highlighted these columns, right? This area, and copied and brought it to the next sheet and pasted it here. And then I deleted all the other columns leaving only close and adjusted close price. Last time I told you the important, although there are 4 price points, right? Open, high, low, and close, right? Uh, Open, high, low, they are all irrelevant, right? Because the conclusion of the day's trading is the closing price at the closing, right? Closing price at the end of the day, just like that for the month as well. This means these are uh, monthly data. So you have opening price of the month, and then high of the month, low of the month, closing of the month. Of course, April hasn't ended, March has ended, so this is March close price. And I told you not to get misled by this calendar date. This is just the date format, right? I mean, if this is daily data, then daily price, then this is March 1st price. But this is monthly, and even for monthly, so this is the end of the month data, so it's March 31st data, but March is represented by March 1st, okay? That's just the way it is. February is represented by February 1st. So this is the way the calendar date is uh, um, used. This is the way the calendar date is represented uh, in the spreadsheet. So don't worry about the whether it is the first day of the month or the last day of the month. I mean, they will always give you the first day of the month, right, to represent the month. Okay. Actually, what you got there is the end of the month price. Okay. This closing is, in other words, uh, this closing is the closing, the last day, uh, closing price of the last day of uh, March, closing price of the last day of February. Okay. And since April hasn't ended, right? Of course, April, this is really the first day of April. And then as of the 17th, right, the closing price of the 17th is the representative of the April closing, because April hasn't ended yet. And also think about it. These dates are really artificial because why? Think about it. Is there any guarantee that the first day of the month is the trading day all the time? What if the first day of, right? I mean, anybody with any sensible mind or with a common sense can easily tell it does. The first day of the month doesn't necessarily fall on Monday or Friday or Wednesday. I mean, what if the first day of the month was Saturday? No trading on Saturday. What if the first day of the month was a national holiday? No trading on that day, right? So actually, the first day of the month is only, once again, it's only symbolic, right? Doesn't necessarily mean that was really the real, trading day. Okay. Um, so anyway, I copied all that data and pasted it here. Simply, select one cell and and I'll show you. And we did it last time, so I'm not gonna. So I copy, right? Bring it here. And just paste, right? Just select one cell and paste, okay? And then I deleted, right? Those columns, right? I think I need to show you again. What I did was simply, I don't need these columns, so highlight those columns and just delete, right? Okay, so that's what I did, and I have only close and adjusted close price left. So then next question is, what's the difference between close and adjusted close? Now, the difference between a closing price is literally closing, but adjusted close price means it's the price adjusted for stock splits and dividends. Okay, stock splits and dividends. So what does that mean? Now you remember stocks pay dividends quarterly, every 3 months, right? Quarterly. And you saw that, in before we downloaded the data. On the web page, it was quite obvious. On the web page, Yahoo Finance web page, it was showing you the dividend payments every 3 months. So there was, a most recent dividend was paid in February, and the previous one was in November. And I told you, February dividend is actually the dividend of the fourth quarter of 2019, right? And you cannot pay the dividend of the current quarter during the current quarter. It's a common sense. Anybody with, any sensible mind will easily understand. The quarter has to close, right? And you compile the data, calculate earnings, and then you can pay out dividends. So the dividend will have to be that it will be executed in the following quarter. It will be paid out, right? So dividend paid in November was actually the dividend of the third quarter of 2019, right? So, but since the dividend is paid quarterly, right? Then every month, other than the out of 3 months, 1 month has dividend. Other 3 months don't have dividends. And so when we calculate return, remember what is return? Let me go back to, I'll first stop sharing this and let me use a whiteboard, right? So you guys remember what return is? First of all, remember first thing is holding period. I don't know if you can. What's the holding period? This is the first thing you learned. During the holding period, there must be capital gains, right? Or capital loss. And then cash flow, sum of all the cash flow during that holding period, right? And divided by price at time t minus n, right? So, or price at time 0, right? So what that means is, suppose we are at time t now. We're just, at the end of time t, then the price capital gains is between the price at time t and price at time t minus n, right? N can be, any number, right? Like it can be, N can be 5 years, 2 years, right? And then that's capital gains, right? And sum of all the cash flows during the holding period. So holding period is actually between T minus and T, right? So there will be N cash flow from N periods, right? For N period. Okay, so this is holding period return, right? But what if it is, just a single period, one period? So if holding period is just one period, we'll just let's call it RT, okay? Return at time T, right? And what is return at time T? Of course, it would be capital gains. But capital gains for one period. So one period means, there will be a price at time T and price at time T minus 1, right? There will be a price at time T, and that's one period, right? So, and then there will be, and if you're talking about stocks, right? There will be, during this period, there will be a dividend. Cash flow is dividend. And one period dividend, right? Dividend at time T. And then the price at the initial price is, right? Price at time T minus 1. Okay. Now then, let's think about it. What is the then one period? If the holding period is one period, right? One holding period, and during this holding period, if you're getting one dividend payment, right? What does that mean? This be at least a quarterly holding period, must be at least quarter, and this is quarterly price, right? This is the price at the end of this quarter, price at the end of the previous quarter, right? Makes sense? But then here we have a problem here. First of all, you understand that not all the companies pay dividend. Not all the companies pay dividend. There are some companies don't pay dividend. Some companies pay dividend, and even if the company pays dividend, it may not pay consistently every quarter, right? Sometimes they skip, right, the dividend, and they may, by the decision of the board, they may stop paying dividend for a very long time, and then then resume paying dividends after 10 years or something like that. Apple actually did that. Apple stopped paying dividends for almost like 10 years in the like early 2000s, and then started to pay dividends again from around 2012, I believe, if I remember correctly. So if the company doesn't pay any dividend, this doesn't matter. I mean, this is irrelevant if it doesn't pay any dividend, right? Doesn't matter. But this becomes a problem. But the problem is, are we dealing with quarterly data? Are we dealing with quarterly data? No, we're not dealing with quarterly data. We are dealing with monthly data. And if you are dealing with monthly data, we have a problem. Why? Because 1 out of every 3 months we have dividend, but then the other 2 months with any dividend. So in other words, the data, there will be like a little spike every 3 months, right? Of course, we can make adjustment every 3 months, but then this will be a tedious job if you're dealing with. Remember, we downloaded past 5 years worth of data, right? And that's 60 data points. Actually, we downloaded 61. I mean, if you're dealing with like 60 data points, right? Making this adjustment every month, every quarter, right? It's going to be a tedious job, right? So what we do, instead, we will use adjusted close price. Then that means, uh, every month, the price every month it has already priced in, right? It's been adjusted for that dividend. So you don't have to worry about dividend when you are calculating the monthly return. I mean, if this return is monthly return, then this dividend becomes a problem, right? Because uh, not every month you have this data. But if you price this in to, if you make the adjustment into every monthly price, then we don't have to worry about it. Another thing, I said adjusted close price means adjusted for stock splits and dividends. Stock splits. Next question is stock splits. And I told you, in one of the past classes, I've told you that stocks uh, stocks sometimes split, and why? Well, they split for liquidity reason. Right? Remember that? I from the day one, when we started talking about return on investment, I talked about this on several occasions. Now, if the stock becomes too expensive, right, then what happens? Um, the stock becomes less marketable. If it becomes too expensive, it becomes less marketable. And I gave you an example with the municipal bond. Remember, the municipal bond has face value of $5,000, whereas all the other bonds, corporate bonds, Treasury has $1,000 face value. And if so, suppose you have only $5,000. If you buy Treasury, or if you buy um, corporate bonds, you can buy about 5 bonds approximately, right? Uh, of course, depending on whether it is discount bond or premium bond, it could be less than 5 or it could be more than 5. But since you cannot buy a fractional bond, uh, if the bonds are discount bonds, you may be able to buy 5 with $5,000 and still some money left, right? If it is premium bond, you cannot buy 5. You will buy less than 5, maybe 4, and some money left. But think about it. If you use that $5,000 to buy a municipal bond, you can buy only one, right? And then think about it. If you need, suppose you put it into a municipal bond, then you can, and you need something happened, and you need uh, cash very urgently, right? And now, if you have, suppose you need, $2,000 urgently. If you have 5 corporate bonds, you can sell two of them, and in other words, cash out 2, and you get $2,000 in cash, and still $3,000 still in the bond. So you can continue to earn. Let's say if the um, coupon rate is 10%, you can continue to earn 10% on $3,000, right? If it was corporate bond that you bought. But if you bought the municipal bond, then there is no way you can conveniently cash out only $2,000. Just to cash out $2,000, you'll have to sell the entire bond. And then you now have liquidity, but then no more interest, right? No more coupon on the muni bond. So that is the reason, the same logic, same reasoning applies to the stock. And I told you before, uh, Apple was about $660 in 2014 before it split. Around September of 2014, it's Apple split. Until then, it was like $660, and it was like a 7-to-1 split. 7-to-1. That means one stock split into seven. So each stock was, then 60 divided by seven. You calculate probably $90, 80 something dollars. So the stock, the price per share became much cheaper, but that doesn't mean you lose money, because if I had 10 shares of Apple, my total investment, my total value of my investment was 6,600, right? And after split, then my number of shares will be 70, right? 70. And then, each share is, like, if it is $90, right? 90 something, right? Suppose, just to make it simple, $90. $90 times, 70. That's going to be 6,300, right? So actually, it was 90 something, I believe. So the total value is the same. But think about it this way: stock becomes more marketable, right? People who were shying away from buying Apple because of too high face value, right? The market price, too high market price, because of the liquidity concern, right? Now can buy Apple more readily, right? So then that's the reason they split, right? But then the next question is, once you split, what happens to the data? If you look at the price data, until like September, it was 660. And then after split, it suddenly is 90 something, 97 or something. And think about it. If you didn't know anything about um, the history, right? Whether they, if you had no idea whether Apple split, looking at the data, what would you think? You might think Apple crashed suddenly one day in September, right? And besides, so first of all, the data loses continuity because there is a sudden break, right? Or disruption in the continuity of data. I mean, how would you, between September and October, how would you calculate the return? You would subtract the September price, right? September price. You will subtract the September price, which is like, 660, right? You will subtract that from the October price, which would be like 98, divided by 660, right? Don't you think this is crazy? I mean, this would give you definitely a negative return, significantly negative return, right? So, obviously, this is a very stupid thing if you do it like this. So what do? You will need to adjust all the pre-split price, pre-split. This is the pre-split price. You will adjust it to post-split price, right? Makes sense, so that the data will run smoothly. So, uh, so let's say if in October, if it was $99 and pre-split price was, like 660, but then you adjust it to something like, after split, adjusted for that split factor, this becomes like, let's say $95. $95. Then the data will run smoothly. You understand? Okay. So let me go back to the Excel, and then alrighty. So now you understand why we use, why we'll need to use adjusted close price. So then I'm not gonna, I will not delete it. I'll just, close that column and change the label, right, to PT, because that's, a dollar price. That's the price, right? And then I won't need I won't need uh, uh, so this is April 1st, and if we're already at the end of April, right? It will be marked. It will be noted as 5/1, right? You understand? 5/1. May 1st represents actually then it would represent the um, okay. So let me delete this, okay? Because currently because this is, we're not at the end of April, but by doing this this is the latest uh, March, I mean April price now. So now it is, consider this as the end of the month. So I want to calculate return. So how do you calculate return? Remember, one period return, or the monthly return, is uh, PT minus PT minus 1 over PT minus 1. Okay, then this is PT, right? Then what is PT minus 1? Where is PT minus 1? PT minus 1 from April, PT minus 1 price at T minus 1, previous month. It is March price, isn't it right? It has to be March price. Makes sense? It's the March price. So then that's PT minus 1, isn't it right? Then PT minus 1 over PT minus 1. Okay? So then this is monthly return, right? Hit enter. Okay, I will give it the percentage, right? Percentage, and give it at least 2 decimal places. Okay, now I would like to give this also dollar sign, because we have so many digits, but if it is in dollars, we don't have any more than 2 decimal places. I mean, meaning we don't use anything more than anything less than a cent, right? So and I can, because it's the same formula repeating over and over, I will just copy and drag it all the way down, all the way down. Okay, but I will stop here because there, it won't compute any return, because to compute return there has to be data, right? But that's fine. That's fine. Why? we have, as long as we have 60 data points, right? That's why as long as we have 60 data points, right? I think that's 60 monthly data, data points. There are 60 of them, right? Because 5 years is 60 months, right? So we got the monthly returns. Then naturally, your next question, you will wonder, okay, I got the, wouldn't you want to know what was the average monthly return in the last 5 years? Yes, you would want to know the average monthly return. So what do you do? We'll take the average, right? So to take the average, you can simply type in, as you type in, AVER, you get, average come up, right? Double click and simply highlight this data range, right? And there's going to be 60 of them, right? And then voila, that is the monthly average, right? Average monthly return. So this is called expected return. Or, average or mean return or expected return. Now, of course, you understand that the average is mean, but why is it also expected? Now, expected value, expected return, when we say expected, this says, expected means, rationally expected. In other words, it's the probability weighted, average. In other words, you might think when we say expected, people generally don't understand what it means. They think that's wished for. I ask the students, many times, many times I ask the students, what grade do you expect from this class? And every time I ask this, then some students say A. That student is either very, ambitious or just wishful, or just clueless, right? I mean, how can you expect A? I mean, if you have been doing well, right? I mean, every exam, every test, you got the highest score, right? And every class you never missed. You have perfect attendance. You have been doing, you've been getting high scores in every exam and every test, every homework. Then you can reasonably expect A, right? But otherwise, if you say A, then that's just the wishful thinking, right? Or otherwise, you're just clueless, right? But then this is important. If your expectation is rational, right? Rationally expected, right? Why? It's based on your, past performance, and it is all factored in, right? So, and statistically, right? Suppose you are, I don't want to spend too much time on this. But in probability theory, right? In probability theory, let me go back to the whiteboard. Suppose you are playing a dice game, right? And a dice is everyone understands, a dice is a fair cube. Fair cube means, uh, uh, it's a perfect cube. And if it is a perfect cube, and there are six numbers on each side, and each number has the same probability, right? Isn't that right? The probability of every number, I represents individual number. Probability of all numbers are 1 over 6. Every number is 1 over 6. Isn't that right? And suppose you are playing this game where you roll a dice and the number that comes up, right? You win the dollar amount matching the number that comes up. So then, what? So in this game, you will never lose anything, but you know that you have only something to gain, and the dollar amounts you can ranges between 1 to 6, and all of those numbers have the same probability of 1 over 6. Isn't it right? As long as the dice is not distorted, right? If it is, not a fair cube, then they would have a different probability, but they all have the same probability because it's a cube, right? Then what is the expected payoff from this game? What's the expected payoff? Okay, expected payoff it's hard to write this. Expected payoff is actually, how do you find expected payoff? Once again, people say $6. No, that's your wishful thinking. I mean, how can you reasonably think 6 will come up, right? So how do you know what's gonna come up? You don't know. So you'll have to weigh. You'll have to weight in every. You'll have to weight every possible number by their weight, right? So that means it's going to be the sum of every number, right? Of course, number runs from 1 to 6, right? And then you will multiply, you will weight the probability, right? You will weight every number, right? In other words, by their probabilities. So that is like, then it's going to be like, 1 over 6 times first possible payoff is $1, right? And then 1 over 6 times $2. And you keep going like this, that. Right? And then, so we truncate the middle, right? $3, 1 over. So then times the last possible number is $6, right? So if you do this, this is what? This is the weighted average, isn't that right? Weighted average, which is, and then each possible outcome, $1, $2, $3, $4, they are all weighted by their probabilities. And then you will find, oh, in this case, isn't this, because 1 over 6 is a common factor, if you factor out over 6, isn't this simply, sum of all the numbers? $1, $2, $3 plus all the way, right? And then plus $6. Isn't that exactly how you find the simple average? Yes. If you think about it, it's exactly right. In this example, in this case, you can factor out the common factor, right? Right, which is 1 over 6, right? And then you sum all the numbers, right? Running from 1 through 6, right? So in this case, it's a simple average, right? So it's a special case of weighted average. Simple average is a special case of weighted average where all the weights, right? All the weights are the same, right? Okay. So then then this comes to, if you do this, this will come to $3, $3.5, $3.50. Okay, $3.50. Actually, think about it. There are 3 pairs of 7 times 3, 21. 21 divided by 6, right? You'll get, right? So think about it. This is exactly a simple average, but this is the expected payoff. Expected payoff. In other words, because it is, all rationally expected. Why? Because you've factored in the probabilities of each event, each number that can come up, right? So this is the most rationally expected, which is just the average, right? In this case. But if the weights are different, it will be weighted average. But with the same weights, it's just simple average, right? But then, now let's think about it. Can you win $3.5 in this dice game? Is it possible? No, it's not. You can't win 3.5. Why? Because 3.5, that number doesn't exist on the dice, right? Right? But still, even though it's impossible to win $3.5, but that's the most rationally expected value, right? So this is why average is called expected, right, or expected return. In this case, let me go back to, okay, application, go back to Excel, okay. So now this is why it's called expected return, right? Expected return is the mean return. So what this is telling you is, on average, right, uh, over the last 60 months, Apple earned 1.81% return monthly, right? So 1.81% doesn't seem very much, but suppose Apple grows. This is the growth rate of Apple. So Then starting from, let's just try this simply, right? If we compound this price, right? If we compound this price, like April 2015 price, 1 plus this, right? Think about it. Annually, it's going to be, the annual return will be 1 plus this raised to 12. That would be annual, right? Isn't that right? And then over 60 months, right? If you compound it, raise it to 60, right? This is what we would expect, like 60 months later. Of course, it may not be, because we are about $50, right? Short of this expectation, right? But still, think about it. The idea is, um, if there was not, a lot of fluctuations during, these last 5 years, right? If it was just smoothly growing at this, we would have got to 388 by now. And another thing, what would be the annual return then? Of course, you raise this to 12 and minus 1. Annually, if it grows at 1.81%, annual is going to be, right, 24%. Make sense? Okay. All right. Next thing. Next. So you would be interested in, we can copy that, and I'll take it here and paste, but I'm going to paste only, look, pasting would, if you paste it, of course, it's going to also bring in all the formulas, right? Because these are based on the formula. And of course, we're going to be losing that because, we don't have the data. But what I would like to do is place it there, and instead of copying the formula, we'll just copy the value only, the numbers, right? So if you go to a paste special and paste values, right? Now let's see. You see, only the values are copied, right? I'm going to close this, right? Then there's one thing you can do. Don't you want to know what was the best, highest return during this period and lowest return? Don't you want to sort it in like descending order? Then, yeah, I did that. And then it was sorted in descending order. So the best month for Apple was August of 2018. Just in 1 month, they gained almost 20%, right? And then the worst month was November of 2018. Just 1 month, they lost almost 20%, right? It may look symmetrical, but no, it's not really. Why? Because if it looks like, if it is 1919 19% on the right tail and 19% to the left tail, and if the mean is 0, then it's cyclical. But mean is not 0, mean is 2, right? Mean is 2, and then upper tail ends at 19% or 20%, 19, yeah, almost 20%. Lower tail, the left tail ends at 18%. So it's, yeah, you can say it's symmetrical in the sense that mean is about 2, and to the right it is 20%, to the left it is 18%. So it's almost symmetrical, but it doesn't, it's just a coincidence. Okay. Next thing. Now think about it. Wouldn't you want to know? I mean, now that you know the mean is 18%, next, don't you want to know the average deviation from the mean, or average, fluctuation from the mean, right? Don't you want to know every month they fluctuated, the return fluctuated, right? From the mean, right? So if you knew the average fluctuation or deviation from the mean, don't you think it would be the next logically, that's what you want to know next, and then at least you would have some rough idea about how wild the swing is, right? Yes, then to do that, we would like to what would you do then? Of course, I will take the difference. I mean, what is the idea? The deviation is basically, we want to know the average deviation from the mean. So deviation is basically the difference between each monthly return and the average, isn't it right? So what I'm going to do is I'm going to take the difference between each monthly return and the mean. Okay, so that's but then I'm not gonna do this one by one. I will just copy and paste it all. I'm gonna just copy and paste it all the way down. But then when you copy and paste it, you have to also realize that as D2 goes down to D3, this will go down to D64, and there is nothing in D64. D63 is the average, so you want to keep it locked into D64. So what do you hit F4, and then the average will be locked, right? D63 will be locked. So when you drag it down, right, it's not going to change, right? It will be always, okay. So then, next question is, I want to then, good. I'm going to sum everything, right? So you want to take average, you will first need to sum everything, right? Isn't it right? And then divide it by the number of data points, right? So you're going to sum everything. And you want to divide it. Then when you summed everything, what happened? It's 0. Why is it 0? I mean, did I do something wrong? No, you didn't do anything wrong. You summed everything. But why is it 0? It's supposed to be 0. It's bound to be 0. Why? Why? Remember what we did was this column, right? Column E. Column E is the column of what? The deviations from the mean, difference terms. Excuse me. What that means is mean is a neutral number. Mean is a very neutral number. And so if you take the difference with the mean, that means half of these data points are positive, and half of the other half is negative. So if you sum everything, they will cancel out, right? The positive numbers will cancel out with the negative numbers. So it's bound to be 0. Then you are at a loss. You don't know what to do. I mean, how do I then take the average deviation if the sum of all these are, sum of all these deviations is 0? I mean, dividing this by 60 will do nothing. It will just give you 0. So it looks like you are at a blind dead end. No, actually, you're not at a dead end. You can get around this. So, question is then, um, how do we get around this problem? Some may think, some of you may say, oh, so it's what if we use only a positive difference term? Well, what's going to happen if you use only positive terms? Doesn't have to be is not going to give you a correct picture, correct representation of uh, uh, the deviations, right? In other words, uh, you are losing the actual dynamics of the price uh, or the returns, returns trend. So you cannot use, only the positive numbers. Then there is one solution. One solution is you will square the difference terms. Think about it. Squaring the difference terms, if you square the difference terms, everything will be positive, right? Any number squared is always positive, isn't it right? So we'll retain all the 60 data points. We're not going to lose any of them. And then we can find the average of all these, right? Think about it. Difference, when we say difference, right? Deviation, right? Some are negative, but negative means it's just to the left side of the left-hand side of the mean. Make sense? The negative values are the distances to the left of the mean, right? And the positive deviations are the numbers that are to the right side of the mean, right-hand side of the average. So actually, in terms of the distance, there's no negative distance, right? It's just to the left of the mean or to the right of the mean. So there's no, it's perfectly okay to use, square terms. And all you need to do is then simply I'm sorry, simply square it, right? We got that, and I'm going to give it, I'm going to do, where is it? Where's speakers? Okay, and I'm going to also give it percentage, right? That's fine. To be consistent, right? And then don't leave it like this because there's a big difference, right? So always use 2 decimal places, right? Or 3, list 3, right? 2 is fine. Now you can drag it down. Okay, then you auto sum everything, right? Okay, so this is, let me do this. Not only this, I will highlight the entire cell. Make it 14. Okay, what is this? this is the sum of all the squared different terms, right? This is the sum of all the squared difference terms. So it's got a name. It's called SSQ. So some of you may ask, so Professor, what is SSQ? What's SSQ? SSQ sounds very cool, doesn't it? It's like a special task force, special squadron, right? Uh, it's a cool name, right? But what do you think is SSQ? What did we do? What is this? This is the result of squaring all the different terms, right? So what does this mean? This is squared sum of squares, sum of all the squared terms, right? Squared difference terms. So it's called SSQ. Okay. Yeah, it's too dark, so let me make it like lighter. Okay. So what is the next thing to do then? Since this is the sum of all the deviations, right? We want to divide it by the number of data point, right? So I'm gonna, because we want to find the average deviation, so I'm gonna divide it by, and we know we have 60 data points because, but then just to make sure, I'm not gonna enter 60 there. Instead, I'm gonna have Excel, I'm gonna make Excel automatically count, right? So I'm gonna use count command, and I will count all the data, right? Okay. So then it's 60. Automatically, it's going to give you 60. But then, oh, you might think, okay, that's good. We got that. No, not yet. Why? Um, when you One thing you have forgotten is that this has a statistical quality, statistical characteristics called, a loss of 1 degree of freedom. Loss of 1 degree freedom. Okay, so I'm going to come back to this loss. Explain. I'm going to come back to this later. Loss of 1 degree of freedom, but for now, take my word for it. You cannot divide it by n. You will have to divide it by n minus 1 because because of loss of 1 degree of freedom, right, in the data set. So if you do that, okay, and that's, it's just too long. You don't want to, I'll just, use only decreased decimal and use only like, 3, right? Or 4 at most, right? 3 is enough. And make it bold. So then, are you saying, average deviation is only average deviation per month is average deviation a month is like 0.618%, only decimal. Now, I'm not that is the this is called variance. Okay, this is called variance. What is variance? It's the average deviation, right, of every monthly return, each monthly return, deviation of each monthly return from the mean. But then this is actually a blown up picture. It's not the life size picture, right? Isn't that right? Why? It's a blown up picture. Why is it a blown up? Because we blew it up. we blew up the difference, right? Actual difference, we blew it up by squaring it. We squared it, right? So this is not the life-size picture of the uh, average deviation from the mean, but this is actually a blown-up picture. So, but then we know how to turn it back to life-size picture. We know how. Why? Because we blew it up by squaring. So then we know how to turn it back to life size, right? How do we do that? How do we do that? Huh? I just dragged it down because of the formatting, right? Because of the formatting, not because uh, we, we know how to revert it back to a life-size picture um, because we blew it up by squaring. So to turn it back to life-size picture, you will only need to take the square root, right? If you take the square root of it, then it will be reverted back to life-size picture. So all I need to do is, how do you take the square root of that? Either S or T, that's the square root command, or you raise it to half power. You raise it to half. Remember, square root is something raised to x raised to half power, right? So if you take the square root, okay, that's what it is. And if you take the, if you adjust the, okay, let me adjust it. If you adjust the decimal places, then 7.86. And so that is the life-size picture of the average deviation from the mean. And it's got a name. It's called standard deviation. So standard deviation is, okay, what's standard deviation? Is the square root of variance. What's variance? Is the squared standard deviation. So variance and standard deviation are like twin brothers, right? Twins, right? A big twin, a little twin, right? Dr. Evil, mini me, right? Uh, but this is the life-size picture. Okay, so we got to the standard deviation, and what does it mean to us? There are uh, at least three things that this can help us. One is, of course, this is average. Standard deviation means this is an average deviation, right, from the mean, right? And it's the life size picture. And you might wonder, oh, also some people may ask, if variance is the squared term of standard deviation, and if the standard deviation is the square root of variance, how come standard deviation is bigger than the variance? Shouldn't variance be, because it's a blown up thing, shouldn't variance be? No, no. This is because we are dealing with a number that is less than 1. Think about it. If you square 2, then it becomes 4. Any number squared, any number greater than 1 squared will become greater than itself, right? But then, number between 0 and 1, when you square it, what does it become? Think about it. 10%, 0.1. If you square it, what does it become? It becomes 0.01. Isn't that right? 0.5 squared, what does it become? 0.025. Right? Makes sense? So any number between 0 and 1, when squared, it's smaller. It becomes smaller and smaller and smaller. Right? So there's nothing wrong with this. Right? Makes sense? Alrighty. So that's it for today. I want you to I want you also I want you to replicate the work, as we do this. I mean, you have downloaded this file last time, so as I did this on your own computer, course, that may not be possible because you're watching this and you cannot do, at the same time unless you have a computer, right? But please retrace this, after this, video. Okay. All right. So that's it for today. Um, thank you for watching, and I will see you in the next class.